Here's everything you need to know to get started with investing. If you're new to investing, it can seem all a little bit overwhelming. Where do I start? What should I invest in? How do I manage my money? And can I still use that money? Over the last 10 years, I've learned a lot about investing, so I thought I'd answer some of those questions for you. 1. When do I start investing? You might have a student loan, or you might have car repayments. Which one do you prioritize? Paying off that debt or investing? There's this thing called the FIRE movement, and it stands for the Financial Independence Retire Early movement. And they have this thing called the Happy Panda FIRE flowchart. It's basically a step-by-step guide of things you need to do before you get started investing. Long story short, you need to pay off 1, all your daily expenses, so food, rent, insurances, all the stuff that you can't live without. 2, make the minimum repayments on student loans, on car loans, and all those types of things. 3, have an emergency fund for about 3 to 12 months. And yes, I'm aware there's a big difference between 3 and 12 months. So which one do you choose? Look, I think 3 to 6 months of living expenses is enough for most people. But if you're a freelancer, somebody that doesn't have stable income each week or each month, maybe 9 to 12 months is going to be best for you. And you're probably sitting there wondering, why do I need one? Well, why do you need one? Well, shit happens. Randomly, your car's going to break down or your washing machine's going to blow up. And the thing is, if you don't have that money in your emergency fund, you're not going to have enough money to pay for your rent. And of course, you're going to want to keep this money in a high interest account, not a regular savings account. 2, what is a high interest savings account? I'm sure this won't come as a shock to most of you, but a regular savings account will pay you 0 or little interest. Whereas a high interest savings account is going to pay you a fair amount of interest with pretty much the same functions as your regular savings account. Now, depending on the economy at the time, the rates are going to change. Right now, I just had a look and you can get between 4 and 5%, but the best thing is to have a bit of a look and see who pays the most. 3, why shouldn't I keep my money in a regular savings account? And this is where we get to talk about the media's favorite buzzword, and that is inflation. Essentially, due to inflation, the money you have now will be worth a lot less in the future. So although you have that $20 in your bank account right now, in 10 years, that $20 isn't going to be able to buy you the same that it could today. So for example, if you're going out for dinner and your favorite meal is costing you about $50 with a drink today, in 10 years, that meal might be $75. So if you kept your money in a regular savings account, you'd be short about $25. So your money is getting affected by inflation. So what's cool with a high interest savings account, if you've got $100 in there right now and it's paying 5% interest, at the end of the year, you're going to have $105 in there. And the following year, it's going to go up by another 5%. What's great about that is it's keeping up with inflation and your money isn't deteriorating. And setting up a high interest savings account isn't going to take you long to do it all, especially if you've got your banking app in your phone. You might be able to do one with the current bank. So after this video, jump online and set up a high interest savings account. 4, do I pay off my debt or do I invest? Now, me personally, I pay off everything as fast as possible because I don't like debt looming over me. That said, the answer to that question best comes by paying attention to your interest rates. So the question to ask yourself, what is your interest rate? Let's say your interest rate is 7 or 8%. That's a huge interest rate, so you're probably going to want to pay that off as fast as possible. But let's say your interest rate is between 2 and 5%. What you could technically do is pay off the minimum payments on your debt and then invest the difference. That said, if your interest rate is 7%, that is a guaranteed 7%. That loan is not changing, that 7% is not changing, which is a huge amount of interest to be paying on your debt. So I definitely would be paying that off as fast as possible. And for those of you that have no debt, that have no loans, and your emergency fund is completely full, I 100% would start investing today. Which brings us to the next question, 5. How much should I be investing? As much as possible, but there is one little note there. Again, the stock market's pretty unpredictable. You don't know whether the returns are going to be high or low this year. So if there's any money you need in the short term, say in the next 2 to 3 years, I definitely would be very cautious with that money. So if you're saving for a house, if you're saving for an education for your kids, or for your own education, let's say, and you need that money in the short term, don't be an idiot with that money. I just keep any money that I need in the short term, normally in a high interest account or something like government bonds, and that way I have cash when I need it. Now, before we move into investing in the market and the stock market and picking stocks and all that stuff, there's one thing you need to invest in first. The one thing you should invest in is your retirement plan. Many workplaces and many countries have a retirement plan. For example, in Australia, they have this thing called super. And in the US, they have a thing called the 401k. And in the UK, they have something called the Workplace Pension Scheme. And the great thing about investing in your retirement plan is it's normally the most tax efficient way to invest in the market. My boss is coming. I'll just wait before I record this. The boss is coming. Hello? That said, there's one thing you need to know about your retirement plan. Is it pre-tax or post-tax? So pre-tax means whatever you're putting in is coming directly from your paycheck before taxes. So you won't have to pay taxes on that money now, but when you take that money out in the future, you're more than likely going to have to pay tax. And if you have a post-tax retirement account like the Americans 401k out there, You've paid tax on that money on the way into your retirement plan, which means when you take that money out in the future, you're not going to have to pay tax on that money, which is a big deal because those investments over the next couple decades are going to compound like crazy. Which brings us to 7, how much should I be contributing to my retirement plan? Over here in Australia, the maximum amount that you can invest pre-tax is about $30,000 per annum, and post-tax, it's about $130,000 per annum. And according to Google, in the US, it's about $23,500, and in the UK, it's about £60,000. That said, you should definitely jump online and check out what your country's figures are, because every year they do tend to change. Also, there is one thing you should find out: whether your employer does some sort of match. It's not very common in Australia, but it's pretty common in the US and the UK. For example, let's say your employer makes a 100% match on all your contributions up to 3% of your annual income. And let's say your annual income is $100,000. That means you're going to potentially get $3,000 for free each year. So don't be an idiot and make sure that you get the maximum from your employer each year. And please recognize that in most countries around the world, your retirement plan is actually the most tax efficient way and tax effective way to invest. So try and max out your contributions. That's what I do, and I think it's so important for you too. Which brings us to 8, who do I invest with? Now, me personally, I have most of my investments with Vanguard. That said, it doesn't really matter who you go with. The most important thing to think about is, are they reputable and do they have very low management fees? There is one thing that I do recommend though, it's keeping most of your investments with one institution. The thing is, if you have multiple institutions that you invest with, it can get pretty messy over time. For example, if your employer is using Vanguard, well, it probably makes sense to have all of your investments with Vanguard as well. It just keeps things simple and you don't lose track of your investments. And a quick tip, it's important to recognize that just by transferring money into your retirement account doesn't actually mean you're investing. You actually need to go into your retirement account and make sure you're selecting an investment and actually hitting invest. 9, what should I invest in first? You're going to hear a lot of terms like small cap, mid cap, large cap, emerging markets, equities, individual stocks. There's so many different options out there. What a lot of employers actually do is set you up for a target date fund. So it could be the target date of 2060 retirement or 2070 retirement. And the mix just looks a little bit different depending on when you're going to retire. So normally when you're younger, your investments are geared higher towards stocks, which means that if they're geared higher towards stocks, there's a greater risk and greater returns. But as you get older and as you get close towards retirement, they're geared more towards bonds, which normally lower risk, which normally lower your returns, but it's a bit more safer as you get older. And what's great about target date funds is it's just set and forget. You don't need to think about it. The mix just changes as you get close towards retirement. Now, personally, my retirement plan is just invested in index funds. All right, now that we've got all of that out the way, now we can talk about the easiest way to invest as a beginner, and that is with index funds. Long story short, I don't try and pick the next Alphabet or Tesla. I buy index funds or ETFs. An index fund or an ETF are pretty much the exact same thing. All they do is track a specific market. For example, the S&P 500 tracks the top 500 companies in the US, or the ASX 200 tracks the top 200 companies in Australia. So as a beginner, the best way to invest is index funds or ETFs. It's set and forget and you don't need to think about it. And I know what you're thinking. 11, what is the benefit of investing in an index fund? You may hear some people around you say, I invested in Apple, I invested in Amazon, I invested in Tesla. But what happens if the CEO of, say, Tesla starts a Twitter war with the President of the United States? Well, I'm going to tell you what, your investments are going to plummet. And if they're going to plummet, you're going to lose a shit ton of money. With an index fund, you're essentially buying the total market. So say in the US, the S&P 500, you're investing in 500 companies. And let's say the CEO of Tesla starts a Twitter war with the President of the United States. That's going to be one stock where you're going to lose money, but you're going to have the investments from the other investments of the other 499 companies. They're going to lift up your investment, and the damage is going to be nowhere near like it would be if you're invested in the one company. That's why index funds are great. And now you're probably sitting there like, Simon, do I really just invest all my money in the S&P 500? Is it really that easy? 12, are index funds even effective? Now, there's this very famous story from back in 2008. So Warren Buffett, this guy, he actually challenged hedge fund managers back in 2008 to see whose investments would perform better over a decade. His theory was that if you invested in a simple index fund like an ETF, like the S&P 500, it would perform better over a decade than those hedge funds that were picking individual stocks and are collecting big fees. And lo and behold, his theory was spot on. The S&P 500 outperformed all these hedge fund managers that were getting paid huge fees over a period of a decade. And if you look at the track record of the S&P 500 over the last 100 years, it's actually got some pretty outstanding results. Over the last 100 years, it's returned anywhere from 8 to 10%. And the thing is, if you have your money in your retirement account for say 30 years at 8 to 10%, that money is going to be an insanely huge amount for retirement. And as Albert Einstein says, compound interest is the eighth wonder of the world. He who understands it earns it, and he who doesn't pays it. And for anyone wondering, so what is your personal strategy? So it's very simple. I buy an ETF every single week and I hold on to that investment with a plan to use that money in retirement. And remember, time in the market beats timing the market. You'll never know for certain when the stock market's going to be up or when the stock market's going to be down. So I use this thing called dollar cost averaging. So regardless of whether the stock market is high or whether the stock market is low, I'm basically buying an ETF every single Monday. And the great thing about this is if the stock market's high and the stock market's low, over the next 10, 20, 30 years, I want to get the average over the time. And what happens when the stock market is extra low? Sometimes I do this thing called cash for the crash. I might have some money parked on the side, and when the market drops and plummets, what do most people do? Most people pull out of the market, which drives prices low, which means if you've got some spare money, it's a great time to put extra money in investments. That said, I automatically transfer money every single week to buy my investments. I don't really look if they're going up or down, I just transfer it over and I make my investment. With a plan over the next 30 years, I have enough money in retirement. Which leads us to one final question, a big one. What happens if I don't have enough money to invest? The price of some Vanguard ETFs sits around $500 plus today. Now you might say, Simon, I don't have $500 to invest. Well, what's great now is that most financial institutions do something called partial shares. So if you've only got $50, you can actually invest that, which is great, so you can invest today. The thing is, the greatest investors in the world, like Warren Buffett and Jack Bogle, the founder of Vanguard, they're going to tell you that investing is boring. So for me, how long does it take me to invest each week? Look, to be honest, it takes me, if I was to average it out over the course of the month, it's probably going to take me about 1 minute per week to invest. And the great thing about that, it doesn't really matter if you've got a $1,000 portfolio or a $10 million portfolio. It's so simple and it takes no time. And there you have it, a very beginner's overview to investing. It's not that hard. I think that most people think money is the scary topic to talk about. They don't really talk about investing, they don't talk about how to make money because it's very taboo. But for me, I think it's important for us to share advice and to be transparent about investing. So if you've got any more questions for me, or better yet, any advice for me, I'd love to see them in the comments down below. If you did get value, be sure to hit subscribe and like this video, and I'll see you next week. Ba-dum-bum-bum.